Uh, Welcome, friends. In this revision session on the topic corporate valuation, I, CA Ashish Gupta, Deputy Director Board of Studies, welcomes you all. Now, student, as we have hosted on ICA website the two lectures on the corporate valuation along with the assignment one. Today, we shall discuss another assignment two, because there are some more questions I want to discuss with you. So in today's class, first of all, I will go through some basics of or I will revise some basics of the corporate valuation. Then I will discuss the assignment with you. So student, this topic is very important from the strategic point of view also, because as the paper's name is Strategic Financial Management. Now, with the spate of the merger acquisition in the recent time, the valuation topic has gained a lot of importance. Even we ICI will have a valuation standard board, and even a lot of progress are we can say innovations are taking place in the field of valuation. And not only that, now today's some of the chartered accountant have adopted, and they have gained. You can say they have considered this line as their main profession. Because now they have in the valuation field, and they are earning a huge good amount of. So, student, with this we start our session. Viraj is saying, good morning, Viraj. Thank you. Thanks a lot. Now, student, when we talk about valuation, although this has been discussed in your study material, basically there are three approaches for the corporate valuation. One is asset-based valuation. Then there is earning-based valuation. Then there is cash flow based valuation. Now, when we talk about earning-based valuation, asset-based valuation, that is one of the very simplest form. And I think in the paper of your corporate financial reporting, you must have gone through some questions, etc. on the same. In this corporate valuation, simply if we talk about the balance sheet, generally these are more used in the purpose when we can say that when a company is acquiring another company, it is more used there. So what we do here, the fixed assets are there, here the current assets are there, here equity is there, plus reserves, then debts, then current liabilities. Okay, simply what we basically do like that, fixed asset plus net current asset, that is current asset minus current liability, okay, minus simply debt. We get the value of our equity. Okay, so by this we can find out the value, but this approach has very least value in case of IT companies. Because in IT companies, the assets are is not of that much amount. And because here the main you can say is a USB of IT company is their intellectual resources or HR resources, their HR team, their human resource team. Because ultimately that is a team, because due to which these IT companies are earning the profits. So for these IT companies, we normally avoid this approach. Next comes now here I would like to discuss with you. There are another three version of the same. That net asset value I have discussed with you simply. Then there is another form, net realizable value. Okay. Now, in this case, in net replacement value, realizable value, we normally go for the what will be the amount that we will realize if we sell this company in the market and debts are paid off. Normally, this is used. This approach is used when company is liquidated. One company is liquidated and then another company buys. Okay, this approach is followed. Replacement when a new company is formed. Okay, students. Overall, if we talk about these three approaches, it is normally indicates that when we are purchasing a company on a going concern basis, then of course this accept this realizable value approach. Other two value approaches give the correct value. Now next we discuss income based approach. Now this approach is normally used when the acquiring company is intending to continue their target company. They seems that they view this company as an asset. Like for example, if I give you a very simple example, now suppose if you want to buy a house, okay, now you have a two objective in your mind. Now in this case, what you see, if you are buying it for your own, if you are buying it for your own residence purpose, of course, what you will do, you will get the thoroughly this house thoroughly renovated. Okay, you will get this house thoroughly renovated, and ultimately you will see how much cost I will have to incur extra. But suppose if you have extra money and you are buying this house only for the purpose of letting it out, so in that case, your main consideration will be not the it will be your rent income. Your rental income will be the main criteria of buying the property, because if you say if I am investing this much of money, then how much rent I will get, or how much if after say 5 year of I sell the property, then what amount I will get. So in this case, you are intending to buy this, acquiring this house for the purpose of letting it out. Okay, so in that case, you will see the cash flows, you will see the profit. Okay, so that's why now it is called income based approach, because you are looking for the income that you will get. Now in this, normally there are two approaches are used. Okay, now let us see what are the steps are taken. Using PE ratio of equivalent quoted company, because it is always better that you go by the market. Okay, market because if you have referred our there is a theory called EMH theory. Okay, now this valuation of theory has also a good relationship between these approaches, because as per EMH theory, market discounts everything. So accordingly, if you go by the any quoted companies multiple, then it will be better, because ultimately market discounts everything. Then next is a make adjustment for risky factors. Suppose if you feel that the income of this company may not be that much easy, or it will be subject to some risk. In that case, you make some downgrade. You make PE some downgrading. Okay, next step. Okay, so by this we can get the value of the company. So it is very important. That is how you calculate the future maintainable profit, because you will like, because in this case of adjustment, I think there is question one in your assignment. In that case, there is some question adjustment like this, that you are deducting extraordinary income, you are adding extraordinary expenses. Like that, you have to make adjustment of future maintainable. So by this, you ensure that how much profit is likely to occur in the future, and accordingly you uh, compute this value. The calculation of earning. This is common criteria. We use the weightage of the past profit, then we compute the profit average. Then compute required yield. Okay, this yield is normally computed by EPS divided by share price, or it can compute it that way, 1 upon PE ratio. Then we compute the capitalized value. Okay, student. So this is a simple approach of computing the value of a business using our profit approach, profit, you can say earning based approach. Right? Namartha is asking, sir, when we use realizable and replaceable value, normally, Namartha, what happens? Realizable value is normally used when we are planning to sell off this company. It may also be used if we are planning, say, if we are expecting that if we purchase the company and if may not to be turned out to be profitable, then we can use this approach. Particularly replaceable value normally we use when we consider that if we have to consider buy the company, if we have to buy the company, or if we have to prepare make our own company, then what will be the cost to us? So normally, because whenever I say, I just give you a very simple example in this case. Now suppose you own a company or you are in a business. Now for some particular task, you have an option. Either you can hire an employee, or you can go for outsourcing the same work. Now in that case, what you do, suppose for the same work, you need to hire 3 employees, and you calculate their salary. So you came to know that, oh, if I hire these 3%, my wage bill is likely to be 1,50,000 per month. In addition to that, there will be some additional expenses or somewhere around, say, 10 to 12,000. So somewhere it's going around 1,60,000. Now, on the other hand, similar work can be done by an outsource agency. So you will outsource this work to them, and they are charging just merely 1 lakh. So in that case, you make a comparison that if I do at my own, then how much it will cost to me. So this is called, that way that it can be used. Now another approach become where we have discussed our asset base. Okay, then we have discussed our earning base. Now we are coming to cash flow based approach. In this approach, what we do, normally we try to arriving at cash flow or free cash flow. Now question comes, why we compute this cash flow? Because what happens when we talk about our profit, etc., earning based approach, normally in this case, what happens, it is very common that these accounting profits are subject to some accounting standards or concept of prudence, etc. And as a result, what happens, their value, they may not exactly reflect the cash flow or inflow, because what happens, because it is always a very popular, it is always popularly said that a company may be earning profit but still they have their value may be declining because their inflow may not be that much. And for example, a company may be selling the goods on credit, and credit sale, huge sale on credit, but the recovery rate is not that much fast. So ultimately what will happen, their cash outflow will be on higher side, and in the end it may be possible that the company may be at a profit, but if due to bad debts, likely bad debts, they may be going to the losses. So cash is the key. So according to sometimes a company may be valued on the basis of the cash flow, that what will be the one expected cash flow. So that's why sometimes, now so far as the concept of free cash flow, I will discuss it separately, because of course there are some questions in your earlier assignment, but I will discuss it separately under the SVA header, shareholder value analysis. Now then, it is very important that you have to see the horizon, because sometimes it may be in your mind. For example, just I take the example of the property. Now you suppose if you have planned that if this much of rent I am getting, after getting this rent, say after 5 years, I will dispose of this property. So in that case, this is called, you have to forecast the period of your cash flows. So forecast the period of the cash flows. This is like that. 1, 2, 3, 4, 5. After that, you sort out the property, liquidate the company, sell the company. So in that case, you have to find this. Now it is very important. Determine the relevant discounting rate to discount the your cash flows, because ultimately it will lead to your computation of how much you have to what is the value, because ultimately it is the date is zero, the period today is zero. Okay, so you have to compute what will be the price I have to pay for this 5 year cash flow. So ultimately this period is zero. You have to see how much I have to pay for this just as in base. So computation of discount rate is another factor, and it may be subject to some, like sometime for this normally we use the WACC. Now question comes, sir, how we get, of course WACC is basically your combination of your equity, debt, and preference share. Normally in most of the questions you will find that there are only two cost factor determinants are there, that are equity and debt. Now in that case, what happens? When we talk about debt and equity, so that equity ratio, it can be computed like using Gordon growth model, or it can also be used by using CAPM. From this you can judge, because for CAPM I don't have to discuss because you are very well versed with this. So from this you compute the value of equity cost of debt may be with you because you are financing this. Sometimes what happens, you are for acquiring company, you may be you are floating some shares in the market, or and on the other hand you are also taking some loan. So in that case, combiningly, you will compute this WACC at which I should discount the same. But a required rate of return and yield are almost one and the same thing. Yield is generally market oriented, and required rate of return in generally it keeps it is the basically you keep in your mind. Say again, I give you the example. Now suppose the property is worth 1 crore of rupees, and annually it is fetching you a rent, say about 6 lakh on an annum basis. So here it is the yield is on this house is 6%. But suppose if you want that I want to 8% of return. So in that case, it is required yield. You want to make because you are making a comparison. You are says you have an investment opportunity of investing say in any project or any business where you are getting the 8% yield, and here you are getting 6%. So you may not be interested in that property. So that is the very important. You have to see required means you expect. Okay, generally required return can be on the basis of market also, because now when we talk about the CAPM model, as I discussed with you, we are talking about a CAPM basically models that at particular systematic level of risk what is the expected return of an investor. That's why in model we use RF plus beta plus minus RM. Sorry, R. So here, one second. Here this beta is the indicator of systematic risk. So here indeed it is the expectation minimum. If I am bearing this much of systematic risk, then what is my expected yield or my what is the required yield? That is. The next is the finding terminal value. I will discuss it separately when I will discuss with you shareholder value analysis. Terminal value normally means cash finance for the infinite period. Or we can say it is something relating to your normal growth. Because sometimes what happens when we acquire any asset, it may be possible that in the initial year, just say in the initial year, the growth may be super growth. Like the business is growing at like 8%, then 10%, then 12%, then 14%, then 16%. It may be like that. But after that, it may be possible that the growth may be stable at say 8%. Because every business has their own time. So now this we have to compute the terminal value for this period. Up to 5 years, we shall compute supernormal growth period. After that, we shall, when the growth will be stable, we shall compute the terminal value. Next comes present value of cash flow and terminal value, and we interpret the result. So this is the overall the procedure. Now, now there is another approach that is discussed, that is called relative valuation. It is also called multiple approach. Generally, this is approach is more used in of unquoted companies. Because where generally in this type of a companies there is no such market are there for computing its value. So what they do, they go for any pure, or you can say any similar type of a company and compare their, we find out their multiples and value accordingly their own company or own target company. Now there are some here it is, we can say that in this we find out the comparable company, because it is very important. Like suppose if I give you a small example now, the company may be unquoted, but it's similar type of a company is quoted. Now in this case, to value this company, what we do, first of all, we analyze the what quoted companies multiples, what is their profit, what is their yield, many factors we consider. Then accordingly we compare the parameters of this unquoted company with the same, or we multiply the same. Now let us see the procedure, then you will get it clear to you. So to find out that driver, it is very important. You have to find out what are the drivers of computing the value, because you can say what are the multiples. Okay, what are the bases? What are the bases of computing the value of a company? Okay, so in this case, we can use two types of a multiple. Okay, now in this case, we can find the value of the company two ways. Either we can go for enterprise value, that is for the whole firm. Okay, or we can go for the equity value. That is, if we are acquiring the shares of any particular company, then how much we pay for the same. This is the two criteria we can use. for the whole firm valuation, or we can say now from this enterprise value, we can also get the equity value by deducting debt from it plus surplus funds. We can also get the same value, not same value, but we can get the nearby value. Okay, students. So let us see. Next, we come to the step 2. Here the step 1. Now it is very important. You have to choose the right financial ratio, parameters, multiples. The choice of the multiple is very important. If it is a good one, then of course your valuation will be the then whole exercise of the valuation will be good. If it is the wrong, then you may then there may be a valuation failure, or you can say that the merger acquisition sometime merger acquisition failed because of this wrong choice. Whatever the multiple they have must have overpaid for the target company. It is a very common thing. So the choice of the this ratio is very important, or the multiple is very important. Now it is very important. Uh, you have to see the choice of a right mix of a comparable firms. Now you have choose the option that you have seen. The step 1, you have to determine what either I have to go for the EV or I have to compute the equity. Then in the next step, choose the financial ratio. Either I choose this PE ratio, I use to P growth, or whatever I want to choose. This is the main base. Next it comes arriving at a right mix of comparable firms. It is very important. You have to see the most comparable firms, most the firm that matches with your attributes. Okay, of the unquoted company. Then next last step is now once you have computed, chosen the multiples, you have a parameters with you. You multiply with them and compute the value or use the ratio. One of the very important parameters if used in a value in multiple approach is EBITDA. Basically, it is called net, or you can say it is basically earning before net. How it is computed? Net income plus interest expenses plus taxes plus debt plus amortization. So EBITDA is basically earning before interest, tax, and amortization. It is a very one of the important factor. And one of the very important tools is used. This is one of the very important tools is used to compute the value of any business. Now I am coming to the related topic, that is enterprise value. What is enterprise value? He measures the prices an investor pays for the benefit of an enterprise cash flow in the form of EBITDA. Generally, we use this multiple and we compute the enterprise value. Now, in this, from the enterprise value, we come to know what is the, you can say, how much an investor should pay to take the benefit of the equity cash flows of the company share. Why it is called cash flow? Because here you see that depreciation and amortization are added back. That's why it is called cash flow basis. Another, this approach is preferable because it can be used to compare a variety of companies. Okay, so that's why normally this approach is used. And it is considered as one of the better measure. Next, when we compute the EV, we can follow the two approaches. One is simple method, another is complex method. Okay, in simple method, what we do is basically based on your capitalization. Okay, so here enterprise value is made number of equity here into the current market price. Okay, generally this is when we compute. Now a question rises, how we compute the enterprise value of a quoted company. So normally, or I forgot, for a quoted company is how we compute the enterprise value. Now question rises, how we compute the enterprise value. Now there are two approaches. One is simple. Simple means what we do, we say this much of simple value is enterprise value. Now for the complex method, what we do, we make some adjustment. First we compute the market capitalization value as computed here. Okay. Then we plus the market price or value of preference shares plus market price of debts or debentures then from this we deduct cash and cash equivalent. Now question rises, why we deduct this cash? We deduct this cash, student, please note. We deduct this cash because when a company is acquiring another company, if the target company already has having a cash, of course, this can be used to pay back the liabilities. So accordingly, ultimately, it is benefiting the potential purchaser. So he says, if I have to pay the price, he already get it deducted. So student, so with this, I hope the concept of EV must be clear to you. I am coming to another aspect. Other approaches to the valuation. Now, when we talk about some other approaches, because although whatever the approaches we have discussed, uh, they are normally used, but in the recent time, some contemporary approaches have also come out. Now, what are these contemporary approaches? Let us see them. First is economic value. Then seven is market value. Then there is another shareholder value analysis. Now, first of all, let us discuss the most important topic, economic value added. Now, traditionally, what used to do, we used to measure the performance of the manager based on the profit. But what happens with the passage of time, it has been started realizing that why should we measure the profit? Of course, sometimes what happens, the profit may be subject to some accounting juggleries. So accordingly, the fact comes out, uh, we should see how much value creation for the company. A manager can be a value creator for the company, or a manager can be a value destroyer of the company. So now shareholders start realizing that we should see that how we the company has what is the value creation for the company, how much economic value has been added. Because sometimes what happens, uh, because I just simply give you a very simple example. Now in accounting, uh, there is a historical cost of concept. Okay, in historical cost concept, suppose the building you have purchased, say say 100 year ago, a company have purchased 100 year ago, some say 50 years ago. Now the depreciated value will be, the value of the building will be zero. Of course, the value of land will be there, but if this is a there is any apartment or there is any say office, so of course the value will be zero. Now, in the balance sheet, if it is showing at a value is a very minimal amount, but actually it is worth say today 5 crore of rupees. So now just you go by see this example that will make you to the crystal clear of concept of EV. Now say there is a company A, they are earning is 12 lakh per annum. A very simple example. Their profit is say 12 lakh per annum. Now what happens? This company is owing from their, or they are operating from their own office. Okay, that got 5 crore worth of office. Okay, now this company has some patents from research and development. This patent to today's, if they go for selling this patent in the company in the market, of course they will get some 5 crore of rupees. Now by this, ultimately, this is a simple example. So just say they have two major assets of 10 crore. Now this has been due to historical cost, its value is nil. Okay, due to writing off P&L expenses, like in P&L account in earlier years, its value also stands nil. In a balance sheet, these two assets having no value, but ultimately they are companies owing this of assets of 10 crores of rupees. Now, suppose if a company is earning say 12 lakh per annum. Of course, from the balance sheet, you will say, okay, the other assets say, in addition to there are some other assets of say 1 crore miscellaneous asset. So if you see, you will say, okay, the company is going well. Okay, if we see on the face, it appears that company is a the manager is doing well because from the 1 crore of balance sheet, they are earning good, but not. It is not like that. Ultimately, there are some set of 10 crore. Economic value is 10 crore is hidden there. Okay, so what ultimately they are getting? Now let us see what they are getting. So here the amount will be is 10 crore plus 1 crore. So it means 111 crore rupees they are invested in this business, and if we compute this return, the value will be sorry, value somewhere around will be return will be so the return will be nearly 1.09%. This is a simple example. Okay, of course, the value there is a proper method. So I'm just giving you, you will come to know that how we the manager is performing because from the profit it is appearing. So that's why EVA is solution to this problem. Okay, they want to know how much actually the value is creation is there. Okay, now what is the method? Okay, as notional tax. It is very important to note. Students, yes, it is not that, it is the notional tax. It is not the actual tax the company has paid. Because you have to see what is, say, your actual profit may be differ and your actual tax may be on that basis. But here, when we are computing EBA, you compute this net operating income after the estimate of saving. On that basis, you will use the relevant tax rate. Okay, from this tax rate, you will compute the notional tax. Okay, this will be your invested capital. This will be your EV. Or another approach, simply Okay, always remember this invested capital includes your equity plus debt plus preference shares plus the R&D expenses written off plus bad debt written off. Okay, normally they etc. Normally, yeah, they compute what are the expenses or when non-cash of types of expenses they normally consider. Or if RD has been, because what happens, this ABA for this ABA model, this model has been invented by the Stewart consulting firm, and according to them, they need to make some kind of 167 adjustment, kind of this adjustment in the profit as well in the capital basis. So of course it is quite bit difficult for this 167 adjustment to make. But normally these are the major adjustments that is not normally carried out for the method writing of this. So this carried you have to adjustment make the adjustment in the asset base as well in the your profit base. Only then you, because here you have to carry a similar adjustment you have to carry out here. Only then you can find out the economic value, correct economic value. Even this also include one item I forgot. Goodwill return off. That has also covered also added that. Okay. Now, student, there is one important adjustment here we have to consider that is normally committed as a student, and where normally students commit the mistake, and that is basically the interest paid. Okay. Please always remember, if any interest has been paid in the profit, so this you have to add it back. This interest has to be added back, and the effect of same can be considered the VAT. Because students see here, here I will write it quick. When we compute the VAT, here VAT means your equity as well as debt. So here the impact of interest will be covered here. And if we again deduct the interest in profit, it will be a double counting. To avoid the double counting. Okay, friend. Now let us move to another topic, that is shareholders value analysis. Somewhere it is called shareholder value analysis, or somewhere it is called share value added. Now, this has somewhere around in 1986, and the consultant Rappaport has said that the valuation, this basis has he has propounded this theory because it says that this theory is basically based on the NPV analysis. Okay, this theory is basically based on the student mind district. The one thing I would like to, my one thing has been left out. One, sorry, I think 1 second. One approach, sorry, I have forgot. First of all, I discuss with you the market value approach. Market value analysis, market value added approach. I'm sorry, my mistake. Dear students, there are some issues are attached with the EVS. Shortcomings are attached with EVS. So every normally outcome, you can say overcomes with the issues of EVS. Okay, normally they cover the okay. Namrata is asking why we have multiplied this. Very good question. Invested capital into VAT because it is the cost of capital, cost of acquiring or using the capital, or it is one term it is also normally used, that is also called capital charge. Student, please see, when you are doing any business, so you have acquired some funds for doing the business. Of course, these funds are not free of cost. So you are paying some cost, and that is called capital charge. Okay, this much of profit I am earning, and this much of charges I am paying. So ultimately, it is my value addition. So it is called capital charge. Okay, student? I hope. Namata is clear to you. In case still you have an issue, please send your query again. Now, MBA approach is basically says that it comes out with this. It is the how we compute this MBA. It is simply the difference difference. So here market I can do one thing, market capitalization, or you can say here I can see market capitalization. You can say that the market value of debt. Okay, student. So market capitalization plus market value of debt minus invested capital. It consists of both equity as well as debt. Okay, diagrammatically I am presenting it to you. You will come to know that. But it is completely said market enterprise value. What is the overall market value of your enterprise? It consists of both market value of your equity as well as market value of your debt. How is the proper scale? 1 second. Okay, student, let us see. This is market enterprise value. Here, the market value of debt. This market value of equity. Invested capital as per EV. Okay, now basically this will be the PV of EVA as discounted by market, because market, what the market does, this is called MV. Now market, what the market does, market discounts everything. So they, what they do, they basically, it is called that market value is whatever the additions PV of the EVA, that is considered the same. Okay. Okay. Now that is clear to you. So basically, this is the called market value approach. Okay, student. I hope it is clear to you now. Now I am coming to another approach, that is shareholder value analysis edit approach. So this approach this approach is based on some value drivers that determines the growth, or you can say approach. Okay, that value of any business. Okay, now what are these drivers? Okay, now let us see what are these drivers. Okay, first there are normally seven drivers. Okay, first is sales, and its speed. Okay, then fixed capital or non-current capital investment. Because what happens when your business grows, of course, you need to make some investment. The investment can be both ways. It can be capital, non-current, or it can be current basis. So normally here we have to see what is our investment. You have to see time horizon, super growth, because during some time, any business may have a super growth. After that, it can have a normal growth, and even can be any no growth. So you have to consider a time horizon. What is the time horizon of the business? Then last is required rate of return. Okay, student. Now, generally, what happens is first, you can say, generally these first three, normally they are affected by some change in percentage. Okay, generally they changes by say some constant percentage. They say like in they can increase by some percentage. So simplest form in this, here we assume that they are similar. Now in this regard, if you recall that there are two questions in your first assignment. The question number, let me tell you, the question number 2 and question number 6. Okay, student, this concept is question valuation. This question two questions, 2 and 6, are based on the concept of shareholder value added analysis. Of course, they have asked you to compute the valuation, but they are having computed basically concept of the share value added concept. So there, here we compute. In this, you will see that how we made the adjustment from the profit of increase, because the logic behind this share value analysis is that whatever a company earns a profit, a part of it is used for making the capital investment, a part of it is used for making investment in working capital, because when a company is growing, you have to make some additional investment. After that, after paying of the interest, etc., whatever is left, if some portion is left, if interest you are not considering free cash flow to the firm, no interest deduction is there. If you want to compute free cash flow to the equity, interest is deducted there. So if you want to compute the value of a business as a whole, then what you do, you don't deduct the interest. Whatever the cash flow is coming to you, out of this, you are making some investment for maintaining the growth in a capital or a working capital, non-current assets, as well as current assets. Whatever you are making investment, after that, whatever is left, that is left for the equity shareholders. Okay. So whatever the value addition will be there, that will be for the shareholders. So that's why this approach has been there. So here in this, one important point is terminal value. Student, please remember, in these two questions, I think you have been asked to compute the terminal value. But sometimes it can be given to you in the provided. It may be said that the terminal value of the project after say 5 year or the 6 year will be this much. So you have to compute the terminal value again. Only the thing is that you have to compute the present value. Okay, if value is provided to you, then you have to compute the present value. Otherwise, compute it. The period for the period of stable growth rate, or no growth rate. Then you compute it present value. So by this, you follow this approach. Here, ultimately, you get the value of terminal. So these two questions are based on share value added approach. Now, last I am coming discussing with you. One approach is top shop. Now, logic of this approach is basically this method is normally used for the companies. This approach is more used for a company's conglomerate which are in diversified business. Okay, what happens? A company may be in various kinds of a business. In this case, what happens? Because for a different business, they have a different parameters and different event buts. So, and even different cost of capital. So even different multiples, more important, different multiples are there. Different factors are affecting the company. So in this case, what happens? To value this type of a companies, what we have to do, we have to find some comparable company. Okay. So we have to use some basis to value this company, pure play firms. We have to look out for some pure play firms that are core in the business. that is core in the same business. Okay, so from this core business firms, you value your own company business by using the average. Okay, there is a question in your today's assignment, but I'm just giving you a very small description here. So steps involved are, first of all, let us see steps involved. First of all, identify the various business sector. And calculate average capitalization for the firm those industries. Then average capitalization rate. We calculate the value of each business, each segment. Okay. Then last, okay, then we compute the average theoretical market value to determine the value of, we compute the we compute the average market value to determine the value of the firm. Okay, student. Now let us take a small break, and after this, I will discuss the assignment questions with you, or the second assignment that has already been posted. I hope this assignment must be with you. So we shall solve the all four questions in the next part of the class. Okay, see you after 10 minutes. Ashok ji. Welcome back, students. Now let us discuss with the first question of the assignment. Namarta is asking, sir, step 2 and 3 is not clear of stop shop. Namarta, please don't worry. What I will do, when I will solve the question, then it will clear to you. Okay, don't worry, have some patience. Now this question is says like that. This question is yours from July 2021 examination. The accident limited reported a profit of rupees 154 lakh after 30% of profit tax for the financial year. An analysis of the accounts revealed that an extraordinary loss of 20 lakh and income included extraordinary item 16 lakh. The existing operation except these items are expected to continue in the future. So it means these are extraordinary items. We have to adjust it. In addition, the result of the launch of a new product are as follows. This is the detail relating to the new product. Now we have to calculate the value of business, assuming that the capitalization rate is 14. Okay, we can say it is an earning based valuation. Okay, next it says determine the market price per equity share of the accident limited being comprised of 2 lakh at of this at 13% equity shares of rupees 100 each and 10 lakh equity shares of rupees 10 each and PE ratio being 12%. Okay, let us start solving the question. First of all, in first step, we have to compute the value of the business. Okay, this value is in rupees lakh. Now we have to adjust extraordinary item. For this, it is essential that first we should compute the profit before tax because we have taken the tax shield of these extraordinary items. So first of all, what we do, we compute the profit before tax. Okay, our reported profit is 154. Our tax rate is 30%. Accordingly, our profit comes before tax 220 lakh. Okay, since it is an extraordinary income, we deduct the same. One second. Okay. So it will be something like future maintainable profit. Okay. Somewhere it will be near to. Now we add okay, the profit from the new will be 56 overall. Okay, now from this we deduct the tax. So student, relevant is 14%. So we take it as 0.04. Okay. So 1400 lakh will be the value of the business. Okay. This will be the value of the business. In the second step, we have to compute the market price of equity share. future maintainable profit after tax. Okay, we got the amount is from here 196 lakh. Okay, less reference dividend. Okay, the number of shares is 2 lakh into 13%. Okay, the amount comes 26 lakh. Okay, the resultant figure will be if earning available for equity shares. Here it is 170 lakh divided by 100 lakh. It comes rupees 1.70 is per equity share. Okay, PE ratio has been given to us. Okay, that is 12. Okay, so market price simple. So this will be the market price of the equity share. So this is the answer solution of the first question. It is a simply profit, you can say earning based approach, in which we have computed the just future maintainable profit, and from this we have computed the market price of the equity share, expected price of the equity share. 1 second, student. Let me check if there is a query. Very good. Janvi, you have asked a very good question. In this case, if the debt is there, of course, you will make the adjustment for debt. You have to make the adjustment for debt in the profit as an interest. Okay, now in that case, you have asked a very good question. Now here you have to first, here the interest will be deducted. Here the interest will be, or you can say here you can say this interest portion can come. Okay, then it will impact your tax point of view. Okay, then what will be the profit? That will be profit available for the distribution. Okay, let us see. This profit will be there. Once this profit will come here, first you will pay out of this preference dividend, because preference dividend is not tax deductible. Please remember it. Okay, so we can say here that this future maintainable profit for the distribution. Okay, and preference dividend is, since it is not tax deductible, it will be distributed here. After that, it will come accordingly. Okay, student. Now I am coming to the next question. Question number 2. Now this question is from your previous examination. Let us read the question. Now in this it says using chop shop or breakup value. It is also called breakup value. Assign the value of a Cranberry Limited whose stock is currently trading at a total price of rupees 4 million euros. Okay, Cranberry is accounting set forth these three business segments. One is customer, wholesale, and retail, and general center. Data for the firms of the three segments are this is for the first, this is for the second, and this is for the third. Now here the segment sale has been given to you. Segment assets has been also provided to you. Now this is the segment operating income. Now industry data for pure play firms. Pure play firms means that is that the core business of this firm is like wholesale. They are in the completely wholesale business. For retail, it is completely in retail business and it is in journal. Okay. Now the capitalize they have given you some relevant factor 0.85 1.2. Here it is this. Okay. Now these have been factor given to you. Okay, you have to compute the value. Now here the Namarta was asking, sir, what are the steps to, and here we shall see what are the steps are involved. Okay. Now let us start solving the question. First of all, what we use first this factor. First we take a business segment. Accordingly, first of all, capital to sales. Okay, we have been given these ratios. Okay. Now segment sale has been given to us. This is our sale. Okay, this is the sale of cranberry, and this is the factor. This is the sale of factors for the wholesale business, pure play farms. These factors are for the pure play farms. Okay. Now we compute the theoretical value of each segment. Okay, so this will be the total value as per this approach, as per this factor. Now we shall consider another factor. Now when we talk about another factor, as discussed, it is a pure play factors, pure play multiples. Okay, retail. Okay, now this is the value. Okay, as per this, the value comes this. Now we compute the value of another. Okay, now another Now this one, now we shall use this criteria of the pure play firms. Okay. Now see, we have computed the value from the 3 points. One on the one basis is capital to sales ratio, then capital to asset ratio, then capital to operating. So we have used these three bases. Now we shall compute the step 3, that we shall compute the average. Okay. So theoretical, we have to compute theoretical value of Cranberry Limited will be found 3,77,700. Okay, student. I hope with this the topic method of chop shop must be clear to you. Now I am coming to the question number 3rd. This question is from your November 2021 examination. If you have any query, please ask me. In this question, it says this information limited year ending this month, March 21. Now this is the sales, this is the operating expenses including interest. This is the 8% debenture figure, equity share of face value, reserve and surplus, market value of DY, this corporate tax rate, risk-free rate of return and market rate of return. So here you can see that this figure somewhere can be used for CAPM. It gives you a hint that there will be some use of CAPM here. Now calculate the weighted average cost of capital, calculate economic value added and market value added. Okay, now let us see the solution. First of all, we compute the weighted average cost of capital, that is called WACC. Student, please note, although I may be using abbreviation, but in examination, just write full form. It will be better. For this, we need two things. One is cost of equity, another cost of debt. Since cost of debt has been given to us, okay, this is somewhere KD, okay, before tax. Okay, we shall use this figure to compute KE. Okay, so first of all, let us calculate cost of equity. Okay, KD okay, back will be here the value has been given to us. That is equity share and this complete total value will be our equity value. Okay, that value has been given to us. So student, now first step is over. That is calculation of weighted average cost of capital. Now we are coming to second calculation. Now sale figure is with us. Okay. And operating expenses also figure with us. Okay, let us calculate it. Sales here it is important. We shall excluding interest. Okay. My mistake. Here it is excluding, so we shall here write excluding interest. So including interest figure is 620 less interest. Okay, so add the 8% on 250. This is 20. Profit before interest and tax. Okay, less tax. Basically, it is a notional tax. Okay, so it will be called net operating profit after tax. It comes 280 lakhs. Okay, next step is calculation of capital employed. So I do it on the next page. Or we can say it is kind of a E. Okay. Now back with us. Here we have computed this back. Same shall be used here. Okay, now next step is computing the market value added. Market value of equity shares. Okay, since in the question it has been clearly provided, let us see. This is the overall value of the firm. From this, we shall deduct the value of debt. Okay, so the market value of the equity share will be 650 lakh. Equity funds, 250. Okay, it will be 1 lakh 50. So market value will added will be, okay student. Now here alternatively it can also be computed both way. Okay, capital employed. It means both debt E plus D. Sorry. Value is same. Either you follow this approach or either you. So I hope with this, this question must be clear to you. Now we are coming to the last question of today's class. This question has been commented in May 2019 examination. Let us read the question. Our question says like that. Compute EVA of Good Luck Limited from the following information. This is revenue from operations. This is direct expenses. That is indirect expenses. That is profit before interest and tax. That is interest. That is the profit before tax, and that is tax. Now profit after tax is 539. Here the balance sheet has been given to us. Here this is equity fund, this is long-term borrowing, this is current liabilities, this is non-current assets and non-current liabilities. Now cost of debt is given to us as 15 lakh and cost of equity, that is KT and KE, has been given to us. Tax rate is 30%. Bad provision of 40 lakhs and indirect expenses and 40 has been lakh has been reduced from receivable in the current assets. Now here, when we compute, as I discussed with you, when we are computing future maintainable profit for EVA, so normally what we do, we carry out these adjustments because this is kind of a non-cash adjustment. And when we compute the EVA, so we normally add it back. Okay, now let us see the solution. If you have any query, just ask me so that I proceed. First of all, our EVA is NOPAT. Okay. Now we have to compute NOPAT. Okay, earning before tax here is 800 lakh. Okay, what we do? Simply we 800 lakh minus tax is 30% plus our non-cash expenses, that is 40 lakh. Or I write like this. Okay, student. Now, if you will see the solution from some sources of ICI, you will see that here the tax has been taken as 231 because here they have taken it on a base of actual tax. But correct approach is that you take notional tax. Okay, so please it is the follow the correct approach. Okay, so avoid it and follow the correct approach. Or it can also be calculated that way. Let it be continue the same. There is no need to run it. Let us or alternatively, just I show you how it can be calculated. Better here. Okay, alternatively, it can also be calculated that way. The answer will be 800. Now, next step is invested capital. Now, let us see what are the invested capital. This, this. Okay. This is reserve and surplus plus debt plus there will be another adjustment of 40 lakh of the adjustment that has been discussed here. This has been reduced, so you will add it back to them because in balance sheet this this debt is basic. It has been reduced from there, so you will add back them. Okay, student. Now we shall compute the WACC. For WACC, we shall ignore this. Okay, whatever is the value same, equity has been given to us, we shall consider the same. Okay, now we compute the EVA. Okay, student. Now, sometime it question can be raised, sir, when here this portion of profit might be included in the same. So there may be a double counting. There may be double counting while we computing the debt. So accordingly, there is alternative approach. At this moment, when this question has come, we have also considered another answer where we have computed WACC based on only your share capital, that is only 1000. At this moment, we have also considered this option. This alternative solution has also been considered. Okay, accordingly, the EVA will be Student, 1 second. I think I received some query. Janvi, let me check. You are saying, sir, it should be 600. I think no pet. Let me check where I have written. Okay, yeah. You are right. Here it is. No pet. No pet means better net operating profit after tax. So it will always be here. It will be 600. It will not be. Where I have mentioned it. No pet after. Let me check. It. Let me check. Where I have used 800, I am not. I am not finding here. Okay, you mean to say this amount? Of course, beta, you are right. It should be 600. Okay, thank you. You are correct. It should be 600. Now, you are saying, shouldn't we use 231? Okay, student, you can use the 231, but since notional tax figure is always better, so it is always better you use this 240. Okay, because it is the kind of the actual tax. Okay, if I consider here, then there are chances of double counting. Which no pet figure we shall consider? Of course, 600. You will consider this figure. Don't worry. Okay, don't worry. You consider this figure. So with this, we have come to the end of this assignment. And if you have any query, you ask me. Otherwise, I wind up the class. 1 second. Okay, student. Now we are coming to the end of this topic on that is valuation. As a customary, I am writing here our email ID, that is in small case. You can email your query to us at this email ID, or you can contact us at this number. So with this, we come to the end of the valuation session, where today we have revised what we have covered in our previous 2 lectures. In addition to that, I've also mentioned how the question number 2 and 6 have been linked with the shareholders value analysis, added analysis. Now, Viraj is saying thank you, sir, for creating the concept. Thanks a lot. And I hope, like Viraj, that conceptual clarity must have been also gained by the other students as well. Okay, student. Now we shall come out with another live revision class after some time. Meanwhile, we shall host the lectures, recorded lecture as well as assignment. So please refer them and revise them, and whatever you are doubt, you can discuss in the class. Okay, student. Have a nice day. Thank you.